Hello, hello, hello.
Can you hear me?
Give me some bumblebees.
Bubbity, 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 bubbity. That was our joke last time. That's what I did last time, MattyP. We got some inside jokes on the HIG podcast over here, you know.
It was funny. Isley was on, and I was like, all right, Bronson, give me some bumblebees. And then I realized I was the only one who knew what they were. It's like an old choir thing, like bumblebee, bumblebee, bumblebee.
Oh.
So, but I like yours better. It sounded a lot better.
Your bumblebee technique would help my golf swing, so.
Maybe. I don't know.
Usually I say strawberry in the backswing.
What helped my golf swing was feeding the jungle with Bronson.
Oh, yeah, that's true.
I lost more golf balls that day than I ever have, but it was probably one of the best golf days I've had. It was fun.
It's so fun.
You made the putt that won the game.
Oh, yeah, I did.
Yeah,
and put my job in question.
Your bonus and everything went down after that.
Big time.
Only because you weren't on my team.
I didn't pick the team, so it's not entirely my fault.
All right, everybody. Welcome to the HIG Podcast. We're really excited today because we're here at the Harris Financial Center. Today, we had a private family office luncheon. It was incredible. We had a lot of local family offices here coming to, get a market update from our CIO, Matt Denning, who you've listened to, and then as well hear from our CEO and founder, Jason Harris. It was incredible. But I'm sitting here right now. I got MattyP in the building. Welcome, MattyP.
What's up? It's good to be here.
MattyP, the man. We've been doing this now. This is episode 9, would you say?
This one, I think this is episode 9. We have a few in the queue. So I'm pretty sure, this is episode 9.
Episode 9.
Yeah. And there's a third voice. I wonder if anybody knows who it is yet.
Ooh, who do you think it could be? Oh my gosh, MattyP, who is it? He has his hand up.
Jason Harris.
So good to be here. Thank you, guys.
Yeah, welcome back.
Thanks so much. Good to be here.
Oh, it's going to be awesome. We love having Jason on. He's all over the place looking at properties, looking at gas stations, making Harris Investment Group go round. So thanks for being here.
Thank you, Bronson. Yeah, can't wait.
I'm pretty excited just because we had such an incredible event today. We had a lot of family offices in the building, and I just really enjoyed your presentation where you were talking about the gas stations, truck stops that we look at heavily. And one of the questions that you answered right off the bat I thought was really good was, why are we looking at gas stations right now? What sets them apart from our bread and butter, which is multifamily?
Yeah, there seems to be a shift that has happened recently, within the last year, where we would focus on multifamily. The majority of what we had was multifamily, correct? And then in recent times, there has been a change where it's more onto gas stations.
Well, things change as the market changes, right? And I think the best asset managers have to evolve to market conditions. So I loved the event today, and I think there was some great takeaways, and I'm realizing more and more, I think we're all realizing that truck stops aren't talked about as an asset class as much as a value-add multifamily deal. And so there's uniqueness to the asset that most people aren't aware to how to underwrite, how to assess it, how to know a good deal versus a bad deal. And so as we dug into more details there, I think it was enlightening to see the interest level of those that want to deploy capital in an asset like this. But until they understand it, they're very cautious. And so going into it in more detail, explaining the why and the reasons why we're really bullish and excited about truck stops right now, and the way that we buy them through the conversion process and with a strong operator we have a relationship with, makes a lot more sense to an investor partner than it would if you're just like, truck stops, I don't know. I don't get it.
Yeah.
Why?
Yeah.
So that I think was helpful. And so, happy to dig into that or go into a little more detail. But with multifamily, which has been, we have a longer track record of success in the multifamily space. We've had some really great returns, especially when the market was really strong for many years. And truck stops were more of a cash flow investment with a nice tax benefit strategy or play with a lower overall return. But with the tax benefit for some investors who could utilize the tax benefit more meaningfully, it made a lot of sense for them to go that direction because they were wanting income as their primary objective with tax benefits. And so truck stops have been a big part of, what we've done here at Harris Investment Group. It's becoming a very significant part of what we do. And at the beginning of the year and as the years progressed, we've been analyzing a lot of opportunities on the multifamily front as well as truck stops. And it's interesting in our analysis how we uncovered over and over again, there's not a lot of deals that we feel like pencil on the multifamily side that would meet our criteria of what we would typically have interest in investing. And that's kind of odd and weird because in the current market condition, there's a lot of stress in the market. And even a lot of distress assets and even sponsor groups who are losing their properties. But values have remained relatively strong despite how high interest rates have gone. But we've got several factors that are working against multifamily right now, working against all real estate, and maybe just overall economy is being impacted because of inflation. You have labor costs that are up. So on the multifamily side, that's your maintenance person, it's your leasing agent, it's your property manager. All of them expect a higher wage and even need a higher wage if you want to really dig deeper into it. These are people who also are struggling to make ends meet in current times. And so a lot of them are demanding more. And if you can't pay it, the good ones will switch to somewhere else who will. And so retaining A-type talent has been tough unless you're willing to pay more. You have obviously interest rates that we were mentioning that are much higher. So supporting a higher interest expense is also problematic in any real estate deal if you're financing. You have insurance that has shot through the roof. We have so many markets where we're seeing 2x or even 3x premiums of what they were 2 or 3 years ago. I mean, it's a meaningful difference. I mean, we're talking about tens of thousands of dollars annually in additional premium that, previous insurance costs were, and so when you have to underwrite that into your NOI, and then lastly, property taxes, which has also been a significant increase in most markets nationally. You add all that up and that all eats into the cash flow and the net operating income. And who bears the cost of that? It's the owner. It's the landlord. It's the sponsors. It's us. So having all of those costs work against you, even in a value add play, which is where we're in, which I love being in value add because we have the ability to increase the revenue potential. And a lot of our assets, I'd say most of our assets, we've done a good job of delivering the pro forma rent rate targets that we've wanted on our in our game plan and in our model, and even exceeded it. But we've had some costs that obviously have hurt us too. And so what we're seeing in new opportunities right now is much higher cost on the operations side and not as strong of rent rate growth with still high interest rates. And it's difficult to find enough upside potential to justify deploying capital. So I think that we may only do 1 or 2 multifamily deals this year. The only multifamily or student housing project that we've purchased is one that was a complete loss to the sponsor group. We negotiated directly with the lender, and it was either foreclose or work with us. And, we were in a good position to negotiate. So we,
good position.
We had all of our fees waived from the lender. We were able to get stronger leverage. They were able to give us better interest rate terms, and the price obviously was a much lower amount than what it had sold for 2 years prior, despite the sponsor group having put in capital to work in it. And the initial down payment and equity, that was all gone. And so that one was a unique, very distressed situation, and mostly a management struggle where they had turned over 5 different property managers in the 2 years that they'd owned the property. And so really we needed to nail the management on that. There was some CapEx needs and some marketing budget needs in order to have events to get the students to want to live, and change kind of the culture there. But what I'm saying is that's the only deal we've pulled the trigger on. in 2024. And you would think that with a lot of the distress that you hear about in the news, there'd be a lot more opportunity on the multifamily side. Ironically, those same expenses I talked about, taxes, insurance, interest rates, and labor cost, who bears those costs on the truck stop side?
Ooh,
well,
good question.
It's a triple net lease arrangement.
Operator.
So it's the operator who we're having lease the truck stops from us. And these operators we bring in who we have a relationship with where they've operated 3 or 5 other sites where we've seen how well they've operated, what they've done with gross revenue, net income, what's the EBITDA of the property, and how strong their profit margins are. So that lets us know how incentivized they are. Well, they're the ones bearing all of those costs. And because of the difficult debt market we're in, where a lot of banks have pulled out, or it's just really tight underwriting guidelines, not as many deal flow is taking place. So when you have a sponsor group like Harris Investment Group, where we have a track record of purchasing value add real estate and truck stops historically, we've been able to get deals done and closed. And so operators look to someone like us to be able to expand their operations. They're often asset light operators because they want to spend their money expanding their operations. But they do own their own sites and stations at times, but they don't want to dump as much equity by owning the property if they could make higher profits in operating. So they'll bring in a group like Harris Investment Group to buy the land, the equipment, the building. We'll put all the money up front to purchase it, and then they pay us the lease. And they'll give up more profit margin now than what they were willing to do 2 or 3 years ago because oil and gas has done well. Their profit margins are strong, and they're not getting as much expansion in their operations because fewer deals are taking place. And so we've been able to find 10 cap type cap rate or higher deals.
It's incredible.
Where 2-3 years ago, we were in the 5.5 to 6.5 cap rate range.
Wow, that's a lot of movement.
Very strong movement, and much higher than what interest rates have gone up. You know, that's a 400 BIP improvement from where it was 2 years ago, and the 10-year treasury is probably up 200 bips. So you're talking about a very meaningful spread that we're now able to capitalize on. And what's great about the value add play in truck stops, in our opinion, is we can buy a TA that's currently operated as such, but bring in a stronger operator who sees opportunities to improve the operations and improve the income. Or buy a ma and pa operator, no-name brand site, and convert it to a TA center with a strong operator. And then when we're purchasing it, we're buying it as a pro forma TA center, but we're able to sell it 3 years later, 4 years later as a stable TA center.
So that's the value add with a gas station.
It goes both sides too on the value add.
That's cool.
We're looking at it as a value add, but the operator is as well.
Absolutely.
So it's really interesting. It's like a double value add play there, which I think is super valuable.
It's almost like we're seeing the potential. Based on our experience, we're seeing the potential if everything lines up right, and then we can take that step.
Well, think about it on the multifamily side, right? We're often putting $2 to $4 million into a property, fix up the exterior, the interior, add some new amenities, storage units, covered parking, whatever the tenant base, would find valuable so that they'd be willing to pay for it. Well, the same thing's true of the truck stops, right? The TA corporate sets what they require in order for it to be run as a TA center, and the operators know what areas they can achieve high profitability and good margins on. And so they're often putting in new bays, a CAT scale, high-speed fuel pump technology so that they can pump more diesel sales per day. They're often lounges for the truckers. They're only allowed to drive for 8 hours, and then they have to park and stay in for 8 hours before they can drive again. And so,
the app too.
Through the app, they can reserve a parking stall ahead of time, and so they know that they're going to have a parking spot, which is another thing that one of our operators does is buy some land in the surrounding area so they can offer more parking stalls for the truckers. They're going to need a place to eat, sleep, showers, laundry facilities, all of that's being offered to the truckers. And so these amenities are being offered. Well, then the truckers stay for 8 hours and they spend their money at the convenience store, at the restaurants, and using some of the amenities, right? And paying for parking. And so all of that's just another way to increase gross revenue at the property. And these mom-and-pop operators often aren't maximizing operational efficiencies at their site. They may not have the capital or the know-how, and so bringing in a strong operator who is well capitalized can invest the and even the recent deal we did, $13 million into the site, rebranding it to a very high efficient TA center. And so what we've seen in some of our recent sales is 5x of gross revenue from a previous site 3 years ago to a strong stable TA site now because of these added amenities that are bringing in higher revenue for it. So it's not as common, it's not something as many investors are aware of, but that's what our role at Harris Investment Group is finding great operators that we can partner with to find a value add play for our investors that's helpful for the operators to expand, ones that we want to expand with because they've done a good job and outperformed expectations on previous deals, but also deliver a meaningful return to our investor base. And so we're looking at it and saying, okay, our value add multifamily, we normally can't distribute cash flow distributions till month 18 to even month 24, depending on the size of the property, because we're usually forcing vacancy to fix it up, improve it, make it look a lot nicer. But truck stops, cash flow day one.
Yeah.
So immediately
awesome.
we can start sending out cash flow. Yeah. So that's definitely a plus and a pro for truck stops. Second, even though there's been a phase out of the tax bonus depreciation loss, it's still 60% in 2024, which because truck stops, the full amount can be depreciated except the land. We're still achieving up to 150% depreciation loss to equity. So invest $1 million, get $1.5 million write-off through your K1, use that $1.5 million write-off against other passive income. Unless you're active in your real estate activity, then you maybe could use that loss against other forms of income, ordinary income, capital gains, which is even a bigger value play, if you're able to.
So if I have an exit, I can pretty much use the depreciation from the gas stations to cover my capital gains on my exit, or if I was a high income earner that year, I had a great year, I can use that.
Imagine that, a phantom loss that's not real, that you can use as a tax deduction against ordinary income rates, W-2 or capital gains. So it's a very meaningful tax loss benefit, which we don't even take into account into our returns.
That's incredible, because just think about how that accelerates a lot of areas of your life. Because 30 to 40%, depending on where you fall.
Well, and when you're paying 6 or 7 figures to the IRS each year, and you no longer have to pay that, but you can keep that and put it to work in your own wealth strategy, imagine the compounding effect that can have over time.
Yeah.
You're either going to retire faster than you thought possible, or with a lot more than you thought you could.
Yeah, I think that's so interesting. And we're not CPAs, but these strategies accelerate wealth. I mean, faster than a lot of other ones out there, because that money's going to go anyways.
We talk about how exciting this is in the office all the time, right, Bronson? But truly, in 2024, taking the tax benefit out of it, truck stops outperform multifamily deals. We're underwriting. They are a stronger play in today's market than that of multifamily. Now, you have exceptions, right? We definitely know that there's going to be some great deals to be had in the multifamily space, but we're not seeing as many as we thought we would by this point.
We see a lot too.
Yeah, and we analyze and
Matt Denning.
I mean, we have 3 or 4 brokers today that we've been on the phones with, right, on the multifamily side.
Yeah.
And still, it's not penciling to the number, the IRR that we want to hit for our investor base, where these truck stop conversions, we're doing some very conservative underwriting on the exit, and we're still seeing our IRR threshold being hit. And the best part about it is the majority of the return is coming from cash flow.
That's a cash flow day one on top of the depreciation.
Think of that. Multifamily, you don't cash flow up front. You will cash flow likely on the back end. But then once it's fully stable, we're positioning it to sell. So the big bulk of your return on multifamily is out on the sell. It's not the duration of the hold period in which you are invested, right? You may get a little cash flow on the back end, and then when you sell the property, that's when you see how well you performed.
So gas stations have cash flow starting day one.
Absolutely, day one.
And depreciation day one.
And depreciation day one.
In the
it's
year,
hard.
in the year that we buy it, we'll generate the depreciation loss.
So I actually have a question about that. If I were to come in and I were to invest, say, $500,000 on a gas station deal, what is my depreciation?
I'm pretty sure, Matt, you did do that. But let's talk about that. Yeah, $500,000 investment.
Asking for a friend.
$500,000 would yield then a $750,000 depreciation loss. $200,000 would be a $300K loss. $1 million investment would be $1.5 million loss. And so we try to simplify it so that you know, based on your investment amount, what type of depreciation loss amount you'd be able to achieve that year. Because a lot of our investors towards the end of the year know what their disposable income is, what their taxable income looks like, and if they can use that deduction meaningfully, they may reverse engineer some of that math and say, I need a $2 million write-off this year, so what do you have that could help me generate that type of phantom loss? Well, we know 1.33 then would allow them to get that $2 million write-off they need. And so if the truck stop's appealing to them and they like it as an investment, that would allow them to deploy the capital before the end of the year and generate the $2 million write-off.
And that write-off it's not specific to just one thing. It can be many things, right? Like if you have a traditional 401k, you want to convert that to like a Roth IRA?
Yeah,
you can do that, but you normally have to pay taxes on that, right? This write-off kind of it covers that.
We've seen some really cool use cases where people will use their depreciation loss to prevent the taxable event of converting their traditional IRA or 401k to a Roth IRA or Roth 401k. The exception there, though, is you need to be active in your real estate activity as a real estate professional. Mm-hmm. So if you claim that designation, that loss, this phantom loss from the truck stop or even a multifamily deal, that's now an active loss instead of a passive loss, which active losses can then help shelter the conversion. And that's so many other cool ways that you can shelter your income from being taxable, when you're active as a real estate professional. If you're not, you still get the $2 million write-off. It's just going to be limited to passive income sources only. Gotcha. And if you don't have $2 million in passive income, it's going to carry forward to the next year. And so some people we've seen bank that depreciation loss until the future sale of a company, or they sell their practice because they're a dentist or doctor and they're looking to retire and they're going to come into a $3 million windfall from the sale. Now they have a $2 million loss in this case that can shelter $2 of the $3 million from the capital gains, and then the other $1 million that they need, they may generate from the sales proceeds of the practice to invest another amount that year in order to get the remaining amount from being taxable. So really cool use cases and ways to use that depreciation.
And it can bank to the next year. Correct.
If you don't use it, you don't lose it. It carries forward.
That's cool.
Yeah, it can be really, really helpful.
Jeez, that's so powerful. Last podcast, we had my brother Corbin jump on, and we're just talking about pro athlete investors. And, pro athletes are taxed by the state they play their game in, and NFL players are paid out by 34, or what's over 34 weeks instead of 17. So, it's interesting because it's like, and I love helping athletes understand this, because a lot of athletes actually do own real estate, and they actually can use the depreciation and invest with depreciation in mind. And so, hearing you talk about it, it's exciting because it's a strategy that it's hard to learn this in school. Unless someone tells you. So how did you learn that?
Well,
tell us about that. I think people might want to know.
I was fortunate early in my career as a financial advisor to be attracting many real estate investors because I myself invested a lot in real estate. And so it's something I enjoyed talking about, and people knew me as kind of the real estate guy or real estate investor. And so with that, I was fortunate to sit in early in my career with a family office discussing some of their tax strategy and estate planning strategies, and learned that this gentleman was actually using real estate depreciation loss to shelter some of his development projects he was selling, or it was a business maybe that he sold, and he didn't pay a dime in taxes that year and had a strong 8-figure sale that year. And I was blown away. And so I wanted to understand and reinforce my knowledge on what this tax tactic or strategy was, and if it was legal or not. I definitely was thinking, geez, this is too good to be true. And so I started to ask a lot of CPAs. I started reading books. I read a lot of the IRS code. And as I got into it more and more, I gained kind of perspective from several CPAs, how they've seen it used and what were the pros and cons. And for me, it made a lot of sense for me to start utilizing that strategy. And so then I learned what type of assets have higher amounts of bonus and where you could generate more bonus depreciation versus others. And then I assessed it from an investment perspective. How good of a overall investment is it? Is it part of my risk profile? Is there a way for me to mitigate the risk and achieve alpha and highest returns? And that's where we kind of formed the value add approach of both multifamily and truck stops being complementary to each other to grow your wealth tax efficiently.
Wow.
And one more thing, Bronson, that just I remember that I wanted to share that you talked about. I was mentioning the multifamily, the back end side is where we get the meat of the return, the bulk of the return, because there's not a lot of cash flow along the way, right? Just to wrap up that point, because this is important and why I'm loving truck stops in 2024, we aim for a 20% compounding return every year. And on the multifamily, if you're not cash flowing meaningfully, the return to hit that 20% comes from the sell price at the end. And you don't know how well you do really until you sell it, right? Well, truck stops, that's not the case. Truck stops, we're seeing double-digit cash flow returns in 2024, despite how high interest rates are.
Wow, that's incredible.
So, I mean, if you break it down, if you're trying to hit a 20% IRR and you can hit 13% cash flow between the actual cash flow distributed and the principal reduction of the loan, you only need to hit 7% of the return from the sale on the back end.
Wow.
And just, that's not that hard to do, I guess is what I'm saying.
That's what I was thinking about.
We're buying it at a 10 cap or better in today's market. We have a couple things working for us. Because of the value add of us bringing in a stronger operator with better credit quality and stabilizing the TA as a high efficient run site versus before where it was a weaker operator or it was a no-name brand, some ma-and-pa type shop that didn't have all the amenities that our sites do. Now we can sell it as a stable TA. Imagine like a Quick Trip, right? Those are well managed, a Maverick. You know what to expect when you go in. Well, that's a TA center. Well, those are trading in today's market at a 7 to 8% cap rate. If we're buying at a 10 cap in today's market, in today's debt being where it is, we have a lot of potential cap rate compression potential for us to sell at a much higher amount once we've stabilized the property and proven out the model that we can hit the return projections that the operator believes that they can hit. And if they hit that, and obviously there's a lot of profit in for the operator, they're going to be able to pay us the lease rate, and there's going to be a lot of profitability for a new buyer to feel comfortable with the operator to continue to pay it. So one, we get the compression because of the stabilization. That's one of the value add approaches. But then just look at things globally. We've got the Fed right now who've been guiding to lower interest rates for over a year, and nothing's really changed until recently. We've just heard that September we may expect a rate cut. from 25 bips, now 50
There's
bips is
50,
on the
yeah.
table, right? And so we're just now seeing the 10-year treasury drop below 4%. And it's been above 4% for a while. December, it dropped just below 4%. But a lot of the commercial financing that we use, which is long-term fixed rate debt, is off the 10-year treasury. Well, if that 10-year treasury or interest rates start coming down, as we expect over the next few years, that's going to make cap rate compression happen even more, which means there's more upside in which we could potentially sell the property. And we're not banking that in. We're not suggesting that that's going to happen. We believe it will.
Yeah.
We don't need it to, though,
Yeah.
in order to hit the 20% return. In fact, we need a 10 cap. We have a 10.5 cap that we're closing on today.
Yeah.
We just need it to go to a 9.75 cap rate for us to hit our 20% return. But what happens if we sell it at a 9 cap or an 8 cap?
Yeah.
That's what is so exciting. That's what makes us
significant.
Because we're in a strong position. We could keep the property longer term, and if rates come down, we have strengthening of the site with the operators that are improving the site, spending money to make it better. And with that additional profitability, it'll make it easier for us to refinance and have different loan options. But we'll get a lower interest rate as well if the rates come down. So cash flow is much stronger if we wanted to hold it. But if we choose to sell at the 3 to 4 year mark, which is typically our strategy, the future buyer is able to access cheaper debt with a strong operator in place that has a proven track record. And so it de-risks the deal meaningfully, the value add approach in which we're using. But there's some meaningful upside potential that we're not even baking in right now that is really exciting, and why Harris Investment Group is really leaning into truck stops and truck stop conversions with our strong operators. Because I think it's a small window of time that we're going to be able to capitalize on a 10 cap rate type opportunity.
Weeks? Are we talking weeks here?
It just depends on how quickly rates move, and these operators see opportunities to lower those cap rates that we partner with them on. And so I hope for a couple more months, we have as part of our game plan to close 3 or 4 more truck stops this year.
Awesome.
Maybe another multifamily distressed type deal. But it could close in the window, is lost. But right now we're going to pull the trigger wherever we can if there is, the opportunity. So we have 9 sites right now that are being discussed if TA Corporate will approve them. And there's a lot of due diligence that TA Corporate goes through before they'll, say yes to a site. And if that meets their metrics and we have a good operator partner who's willing to partner on that site, then yes, we'll have some deals, and we're hoping at that 10 cap range.
I love that our listeners get to have that insight. And so I think it's just so valuable because it's live insight. Like, this is happening right now, and it's super valuable for anyone, that is, looking at the markets into real estate, and it's just so valuable. So we really appreciate you hopping on today with us, Jason. Yeah, and MattyP.
Yeah, thanks.
Thank you.
Thanks for coming on. It's always great to have you. These events that we throw here, they're very exclusive, very small group, whether it's a family office or a group of CPAs. It's very valuable knowledge that we are giving to people who are very smart and know, how to use it. So for you to come here and to share that here on the podcast for our listeners to hear, it's a lot. It means a lot.
I have a little bit of passion about this, so I'm so glad that I had the opportunity to talk about it with you today.
Yeah, well, it's awesome. Thank you very much. And for anybody listening, if you guys have any questions for us, for Jason, Bronson, myself, or anybody else here, please email us at contact@harrisinvestmentgroup.com. And in the subject line, just put HIG Podcast, and we'll get back to you. That's a wrap. That does it.
Thank you.
Thanks.
Thank you. Hope you find your friends.
Hope you find your friends. Oh, I forgot to hit record. I'm just kidding.
Oh, that would be so bad.
I knew I always check that.